This is a Momentum Media production.
The SMSF Advisor Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hi everyone and welcome to the SMSF Advisor Show. I'm joined by Aaron Dunn, my co-host and CEO of Smarter SMSF. Hi Aaron.
Hi Miranda, how are you?
I'm good, thanks. How are you?
Not too bad. There is a bit of a sense that we're into the year. Things are certainly changing. Even got flights and travel around the country next week, which is going to be very different. So getting back on the road, events coming up to look forward to, not having to learn in front of a computer, watching people on a screen is very, very exciting.
Yeah, definitely getting back to a bit more normality now. And it's been quite a big fortnight with the super changes finally getting passed.
Woohoo! Yeah, absolutely. So that was really, really pleasing because we did know that there was a limited number of days for that to get through. And so to see that and to go through as rapidly as it did was a real positive because it gives everyone certainty now in terms of what the advice might look like as we move into the next year, regardless of what government ultimately gets formed as well. So things I know historically the last few years, it's had all those challenges of an advisor saying, well, someone was 65 or 66 years of age, but they could make a contribution, but we were waiting on the bring forward rule. So, what level of contribution should they make? All that stuff we don't need to worry about because we have the absolute clarity and certainty around a number of issues, as we've spoken about on this podcast before, work test removals, reduction in the downsizer age, increase of the first home saver scheme, the SG removal, and of course some impacts around ECPI that impact the 2021-2022 SMSF return. And so the only thing we are waiting on really going back to those previous budget measures were those SMSF specific ones around residency, of course, and the legacy pension conversions. But if I'm a betting man, I presume they'll be reaffirmed in this year's budget. And then we just need to sit and wait and see what unfolds.
Yeah, we'll see what happens with the election and everything to see what happens with those.
Yeah, absolutely.
We also saw some new research come out, which sort of supports some earlier research that we had from Rice Warner, and that was around sort of SMSF minimum balances and what sort of might be an appropriate level generally for setting one up.
Yeah, so this was research that the SMSF Association had done in conjunction with the University of Adelaide and also with data from both CLASS and BGL. And there was, I think the representation, so the sample size was data from greater than 50% of all SMSFs inside the superannuation sector, which is an absolute enormous data set to be able to look through. And really, this is showing as an industry what sort of information can be put forward. And to the SMSF Association's credit, trying to dispel a lot of the myths that exist around this. And ASIC, quite clearly, probably in the gun a little bit, I guess, when we think about it, because the fact sheets that they had historically spoke about, costs, and the SMSF Association really debunked some of the published stats that they had and the reliance upon static data and so forth. And this now goes to the heart of one of the other issues that ASIC was quite emphatic on around balances and rates of returns now with balances, not just looking at costs, to not only give that comparison around what might it cost at different thresholds, but what sort of rates of returns are actually being achieved in these different levels as well in terms of fund asset size. So these are really positive things for the sector. I know cloud-based technology is enabling the SMSF Association to get this sort of data. And now the pressure is back on ASIC to really come back and go, okay, well, this is information that can be and should be relied upon to really reset the way in which their regulatory guidance needs to be to the consumer landscape as well.
I think there's been a bit of frustration on the part of the association and the whole industry that it has been kind of a slow process trying to get ASIC to revise that data they had on the costs, even though there has been this research with more sort of accurate data on that. There hasn't really been that much action taken on it.
Yeah, and that's the problem. I mean, you could hear my frustration in my voice probably talking about that as well, doing a bit of work with the SMSF Association over a long period of time. And it's the advantage now of having live data. It's the advantage of having collaboration as an industry with software providers that provide anonymous data to enable the University of South Australia to be able to use their skills to incorporate some critical data that enables informed decisions. Because the problem, of course, is that licensees then take what ASIC says as gospel, and it then influences the outcomes of those that can provide advice in this space. And so it's trying to debunk and then unpack these issues so that the quality of advice and the way in which advice can be provided with the information that is being used is accurate and reflective of current day rather than just historical data and static data that ASIC's trying to utilise to validate and justify their position.
We also saw the ATO release their SMSF statistical report, which had quite some interesting findings as well. It sort of showed what the initial impact of COVID had on SMSF investments, with a lot of them incurring negative returns for that income year.
Yeah, so this is a great tool for advisors and practitioners each and every year. So I've kind of relied less upon now the quarterly statistics that come out, because they do need to get updated regularly, and spend a lot more time looking at the annual statistical summary, because it not only goes through and looks at areas of contraventions and asset values and how much is in retirement phase and so on and so forth, but it also gives you some interesting insights into service providers as well, what the audit profession looks like in its totality, what tax agents look like in their totality. So the past couple of years, the ATO has really reinvested a lot of resources into getting this publication beefed up, and it does provide some fantastic data into what's going on. And as you rightly said, the COVID impact you can see, in there without question. And we can also, identify just what sort of uptick we're seeing in the SMSF sector from an establishment's point of view, which, yes, it comes through in the quarterly data, but also we get this consolidated view at the end of each financial year as well.
We have a very special second segment today. Annie Kane, who is the editor for the mortgage titles, is going to be interviewing Stephen Jones, who's the Shadow Minister for Superannuation and Financial Services. We're going to be discussing a range of issues in the finance sector, including superannuation and particularly advice as well.
Hello and welcome to this election special podcast. I'm Annie Kane, editor of the Mortgages Titles here at Momentum Media, and today I'm pleased to be joined by our special guest, Stephen Jones MP, member for Whitlam, who is the Shadow Financial Services Minister and Shadow Assistant Treasurer. With a federal election coming up in a few months, the nation has been reviewing their politics, reflecting on their experiences over the last few years, and considering who they'd like to lead them in the next government. For financial services, credit and superannuation, the decision is heavily weighted by what each political party intends to do around regulatory burden, taxation and business support. So in this episode, we are catching up with the Shadow Financial Services Minister and Shadow Assistant Treasurer to find out what the Australian Labor Party would like to see happen in the financial services, credit advice and superannuation space if it were to win the federal election. Many thanks for joining us, Stephen Jones. How are you going?
I'm really good, thanks. Great to be with you and great to be talking to your colleagues. So a big shout out to all of you who are hard at work helping Australians sort out their financial affairs and to ensure they get their best deal with their credit and mortgages.
Now, they have indeed been very busy, and what a couple of years we've had. Obviously very tumultuous in Australia with COVID having changed our working, social and even spending behaviours. Who knew that toilet paper and hand sanitizer would become such hot commodities? But I think it's fair to say that Australia's done pretty well when compared to other countries. But when you actually think about the role that financial services advisors, whether that's wealth, credit, super, accounting, broking, has had on the financial being of individuals over the pandemic, what sort of role do you think they've played?
Oh, look, I think they've played an incredibly important role in difficult times. Let's just sort of break it down into a few areas. If you look at the area of credit and credit advice, we went into the pandemic with record low interest rates. We saw those drop even further. We saw a monumental effort from the Reserve Bank and the banking sector at large to ensure that our credit markets were working efficiently to provide not only stimulus but also emergency support. We saw unprecedented growth in the residential property market. We saw a lot more buyers than sellers in the market. So there's been an enormous lot of momentum in that area. And I think the one thing that we can be certain of is those buyers, those people in the credit market who got access to advice, including myself, got a better deal than those who didn't. So I think it really puts a spotlight on the important role that credit advisors, mortgage brokers and their colleagues are playing in supporting Australians to ensure that they get access to credit and they get access to credit safely and at the right price. So incredibly important. And that's even before we get to the financial advice side of things. It's not like people stop retiring. It's not like people stopped investing. It's not like people stopped switching their superannuation arrangements throughout that period. So all of those needs continued. All of those basic stuff that happens every week of the year was going on in an incredibly uncertain time. So never more important that Australians get access to quality financial advice. And the one thing that I'd say in the middle of all of that is at the time when Australians needed financial advice the most, changes that the government has put in place and the mishandling of a whole bunch of stuff has made it very, very difficult. The advice gap is big and growing.
You mentioned that and the difficulty the financial services sector in particular, wealth advice has had as a whole. And obviously not only this year, this last couple of years, but really ever since the Banking Royal Commission of 2019, when the final report came down with all of its new recommendations, new requirements, laws and obligations were brought in across, not just wealth, but broking and superannuation. And while the changes were obviously intended to reduce misconduct and raise standards, that was the whole purpose of the Royal Commission, they've also added compliance and education costs to nearly all aspects of financial services and credit advice, which some say make the cost of being a professional in this space untenable. Our wealth advisor audience is obviously very interested in hearing your assessment of the Liberals' treatment of the advice sector, and advisors in general, I think, believe that they're being over-regulated. Do you agree? And if so, what would Labor do differently?
I think the first point I want to make is the mishandling of reforms, let alone the content of those reforms, but the mishandling of those reforms has been a disaster. It's visited unnecessary pain upon the advising sector. We have had a tsunami of regulatory change right across the financial services industry, no less in the financial advice area. There was a whole bunch of changes that were in play that there was a known timeline for it, not going back months or even years. Some of this stuff has been 5-6 years in the making. How a government could so monumentally mishandle a bunch of this stuff is beyond belief, particularly a government that says it's a good economic manager. It is just beyond belief, the mess that they've created in this sector. You ask quite rightly, what would Labor do? What would Labor do differently? A couple of things. Firstly, we believe that the transition to a capital P professional financial advice sector is in the best interests of consumers, but also in the best interest of the profession. So 100% on board for that project. It needs to be done properly. If I could just pick one example of the mishandling of it, assuming that everybody who holds a financial service license is providing one sort of financial advice, whether it's life advice, risk advice, or whether it's wealth management advice, and trying to ram everyone through a professional qualification that fits that particular view of what the industry looks like is just absurd. And not enough attention has been given to the need to manage this transition properly and to ensure that new people want to come into the profession, but existing advisors who've got decades of unblemished advice service. People have been doing a fantastic job for decades. Why are we driving them out of the industry at a time when Australians need access to this advice? So We think fixing the advice area is the great unfinished business in the financial services area. It absolutely needs attention. Australians are retiring with more money than they have ever had in their life because of universal superannuation. The average Australian woman close to $120,000, the average Australian man close to $190,000 at the point of retirement. Yeah, the gap's too big and we've got to fix that between men and women. But the thing that is common across everybody is that they need access to the right sort of advice at the right time. And the changes that the government has put in place has made that harder. So I take a bit different approach to that the government has taken. The profession is not homogenous. You've got brokers, you've got advisors, you've got risk advisors, you've got wealth advisors. There is a core level of qualification that is needed that is common to all of them, but there's also specialisations within the profession that need to be accounted for in the accreditation and licensing system, and we want to fix that. That's absolutely critical. But I think we also need to understand that not everybody is going to need the same sort of advice, and they're not going to need the same sort of advice at every point in their life. So the existing market is busted. It's not going back to the way it was 10 years ago or 20 years ago. So we need a new business model, and it's not one. It's lots of business models which provide reliable professional advice and information to people. Government has a role. Advisors have a role in all of this. It has been pitched to me that the silver bullet in all of this, the one big solution is to let all the big funds, just whether they're industry funds or retail funds or whatever, just change the intra-fund advice rules and that'll fix everything, and the funds can just get into the advice business. I'm incredibly unattracted to that proposition. You mentioned Hayne. If we did that, it'd be like just setting the clock for the next Hayne Royal Commission, with that sort of supercharged vertical integration model. So we need different approaches in this area. Government sets the regulation and facilitates and has a role in some parts of the market, but I think it's up to the sector, the advisors, the professionals within there, to come up with the business models that provide consumers what they want in a safe environment. So absolutely focused on getting that right. If we win in the May election, like I said, advice, it's an unfinished piece of the puzzle that we need to get right.
Yeah, so it sounds like there you're sort of saying rather than having one overarching requirement, tailor it to what the different segments are. And you mentioned there as well about an unblemished record. It was something that you'd also mentioned in December at the AIOFP conference, where you said that your party would not require advisors with 10 years of experience to complete a university degree to practice. Is this still the position? You're saying you're not necessarily requiring a university degree to practice, but would want something appropriate to that particular segment? Is that what the Labour Party sort of handling of the new education requirements would be?
Yeah, so a new person entering the industry today, an appropriate degree qualification with additional professional stuff is absolutely the right model. But we're in a transition, and there'll be a bunch of people who've been providing excellent advice for decades that we don't want to tip them out of the industry at exactly the time when we need them. We need them as mentors, we need them as service providers, we need them as trainers, we need them in the industry. An example that I've used in the past, why are we requiring a stockbroker to be able to pass an exam on risk advice to continue what they've been doing for 30 years? They may not have a financial services type. They may have an accounting degree, or they may have an economics degree, or they may have some other relevant degree which has been entirely useful in their professional life. So let's take a step back and say, let's do some recognition of their prior learning and experience. Not a Mickey Mouse job, so we'll do it properly. There's been some concern in the sector for everyone who's done the degree that, oh, that was a waste of time for me when somebody else is going to get a free ride. We're not saying that. Let's do a proper recognition of your professional experience and qualifications so that you can jump through the right hoop for you in a way that is good for you but safe for the people you're advising. That's the way want to go. I think it just makes militant good sense, to be honest.
And just while we're sticking on advice, the other big topic of conversation recently has been the proxy advice changes. And Treasurer Josh Frydenberg recently accused almost Labour of conspiring with the Greens to block the proxy advice changes. So according to Mr Frydenberg, the reforms were designed to improve accountability and transparency of the proxy advice sector. What is your view? What's Labour's view?
Labor conspired with good economic management and good sense to roll one of the worst pieces of regulation that I have seen in my 11 years in Parliament. This was a solution in search of a problem where, the Treasurer, for whatever reasons best known to himself, decided that he was going to create a new set of regulatory requirements which would effectively have shut down an industry. Proxy advisors, most Australians wouldn't even know what they do. They provide a very bespoke advice service to institutional investors. Now, we're not talking mum and dad trying to work out where they put their super. We're talking about institutional investors with funds under management north of $150 billion. So the proxy advisors provide advice to these sorts of institutions on how they should vote at annual general meetings. And any big institution will have literally hundreds and hundreds and hundreds of funds in hundreds and hundreds and hundreds of different companies. So proxy advisors provide very useful bespoke service to these guys to assist them making their decisions on how they exercise their institutional votes at AGMs. A good service, it's needed. There's about 4 or 5 players in the market. They do a good job. From time to time, they might create some discomfort for boards and directors, but hey, if company boards have got to justify why they're going to get a pay rise or their actions over the course of the previous year, that's got to be good for shareholders. So the regs were bad to the core. They were universally panned, not just by my side of politics, but by the business community at large. They've been dumped, and that's a good thing.
So you wouldn't want to necessarily see new regs that deliver the same outcome but in a better way. You want to just get rid of it altogether.
Treasury has looked at this about 4 times over the last decade and said, no, there's nothing here to deal with. There's no problem to solve. But if there is an issue, yeah, of course you deal with it. But frankly, in my in-tray, there's a lot bigger priorities than that. Let's deal with the problems that are existing in the advice sector, for example. We've got a revolution going on in the payment system with just, different payment platforms, over-the-top providers, regulation that was fit for last century but not this century. I've got to say, if I was going to spend a whole heap of time on a new project, advice and the payments platforms and systems would be very close, if not on the top of my in-tray. And fixing a problem that doesn't exist would be at the very, very bottom of it.
So let's go back to talking about advice. And there's been some lobbying from a range of financial planning and accounting bodies pushing for certain types of simple strategic advice to be excluded from the AFSL regime, such as certain types of super advice, for example, starting a pension through super. And their argument is that this would make it easier and cheaper for advisors to provide this kind of advice and also allow accountants to provide it without having to be under a licence. Is Labour considering making any changes to the current advice framework around strategic advice?
Yeah, look, we haven't considered that yet. And from opposition, you want to be very cautious about fundamental changes in some of these areas. You want to be able to consult widely with the sector, ensure that whatever you do doesn't have unintended consequences. I think my record in opposition can speak for itself on this, though. I've started with some views. I've said, people, here is my theoretical framework on these things. But if when we get down onto the ground, that theoretical framework is just impractical and doesn't work, then prove that I'm wrong and, I'll reconsider those things. And in a whole bunch of areas, I've been very frank and upfront and said, this is what I think. What do you reckon? Is that going to work? And I've listened and changed my mind on things. And that would be the approach that I would take if, in a few months' time, I'm the minister in this area. You'd want to take a consultative approach and be cautious but not sclerotic in the approach you take to necessary change. So if I could characterise what I think needs to happen like this, there's a whole bunch of clean-up things that you need to do. We've discussed one around qualifications and that. We need to run our eyes over the regs and guidance that exist around, the consumer credit area. We need to look at the regs and guidance around statements of advice in the risk sector and in the life sector. There's a whole bunch of just clean-up things that we need to do that we can and should do. And then there are some of these more structural reforms that need a deep dive. And that I've mentioned a couple of them, and the stuff that you've mentioned would be one that would be in that bundle.
And just on credit there, I mean, obviously mortgage brokers have historically been excluded from financial services laws. But again, talking about the Royal Commission, one of those recommendations was to bring them into closer alignment with the financial services industry, with a best interest duty having been brought in at the beginning of last year, 2021. Another recommendation was to move them away from the current commission model and move to a consumer pays model. And you previously told me that the Labour Party wouldn't look to change the current remuneration structure. However, should Labour come into power this year, would it look to review broker remuneration as the Morrison government said it intends to do? And if so, what would this entail? Brokers
are now the major front door to customers entering the residential mortgage market. They are overwhelmingly the majority entry point for ordinary customers entering the mortgage market. Customers are getting a good deal. I can speak from personal experience that customers are getting a good deal because they consult with their credit advisor, their mortgage broker. If it ain't broke, don't fix it. I've made it very clear at a conference that I was at that you reported on a couple of weeks ago, we will not be changing. We will not be implementing that recommendation. We respect the Commissioner's views and analysis, but when we looked at how it would operate in practice, we don't think got the balance right. So we won't be making that change.
And would you be reviewing remuneration at all?
Well, look, that's something you do in the normal course of events, but frankly, I don't think there's a problem there to fix.
Yeah.
There is not a problem there to fix. And if things changed and we saw sharp practice or unethical practice, then you deal with the sharp and unethical practice. But frankly, what I want to see brokers focusing on over the next 2 years, when we can be absolutely certain that interest rates are going to rise, there's only one way they can go from now. Interest rates are going to rise. Lenders are going to be already changing their pricing around fixed and variable interest loans. We want brokers to be 100% focused on ensuring that everyone on their books has access to the best priced mortgage at a time when we know mortgage rates are going to go up and cost of living pressures are huge. We think the changes around uniform commission models right. We don't think more needs to be done in that area. So that's where we want mortgage brokers to be focused on. Their customers, getting it right for their customers. If something way down the track emerged where, people were doing the wrong thing, then we focus on the people doing the wrong thing, but we don't need sledgehammers to break walnuts.
And you mentioned there about having your own experience there, sounds like with the mortgage broker. Could you walk me through what that process was like? Do you think that it's something that, you'd recommend to other people?
Oh, look, I consider myself incredibly busy. I've been a pick and stick guy. I've had the same residential mortgage provider for over 20 years, had a couple of different homes over 20 years, but the same provider. I've just, gone back to the paddock that I knew best. And I thought, it was after dealing with this stuff in the last parliament and having a lot of mortgage brokers come to me and talk about what they do and all the rest of it. I thought, I'm going to give you guys a go. So I did it, and I can absolutely guarantee that I'm paying less for my mortgage today and probably will be well into the future because I took that step and reached out to a broker. So I see the value that you guys bring, and more strength to your arm. I'm better off for it, and so are millions of Australians.
And we're talking here about, obviously looking at repricing, refinancing, helping Australians ensure they can afford their mortgage and are able to manage their repayments when interest rates go up. Do you think that Australians should pay for mortgage advice?
Well, they are paying one way or another. There's no such thing as a free lunch. So, the commission that is paid by the institution, by the lender to the broker is priced into the overall cost of a mortgage. For God's sake, banks charge you a fee to use an ATM, okay? They charge you a fee to use tap and go at a supermarket. They're pretty good at factoring in all of the costs of a transaction, whether it's a mortgage or a transfer somewhere else in their payment systems. Anyone who says the price of a mortgage broker isn't being passed on to the customer somewhere along the line doesn't get how these institutions work. So customers are paying one way or another. And yeah, it should be transparent, and the ethical requirements on advisors and the best financial interest duty make all of that sort of stuff transparent. That's a good thing. And I don't see a long queue of customers coming to me saying, we want to change this.
And I suppose the Australian property market as well, just looking at that when, goes in hand with mortgage brokers. And that's really been an incredible success story over the last couple of years. And really the COVID-19 pandemic, I think, has shown us that the great Australian dream of home ownership is alive and well. But even despite the low interest rate environment and record levels of mortgage activity, it's still challenging for a lot of first home buyers to get into the market now, with house prices being what they are and with saving for a deposit now estimating to take around 10 years. Is Labor concerned about housing affordability? And if so, what measures would it seek to take to help make more home ownership more affordable for Australians?
Yeah, deeply concerned about it. And if you think about the overall market of consumers, let's call them Australians, not everybody's got the same problem. So there are a group of Australians on low wages or from whatever their life circumstances, personal crises, all the rest of it, they're never going to be in the position where, for whatever reason or another, they're going to be able to afford their own home. This group of Australians needs a very different solution to young professionals who, look at the price of houses going up in the places where they want to live, but, know if they save right and get the right sort of advice, they'll be able to enter the market at some point in time. Then there's another group of Australians who want to upsize or downsize. And, there's different solutions that are going to be needed for each of these groups. There is a group that we're deeply concerned about, and that is the group that is going to be squeezed between, who, depending on government policy settings, could be squeezed between the never be able to afford to get a home and will be able to, but not sure when. And our deep concern is with prices going wild, wages incredibly flat. People in Sydney made more money in the increase in their housing over the last 12 months than they did in just about any job that they had. And you got to ask yourself, that's great if you got a house, but that ain't great for the next generations of Australians who are trying to get in. So different solutions in every part of the market. Some of it is government providing support for social housing. Some of it is about government working with market and property developers to get more affordable housing. That is, a housing stock which is going to be available for people to enter the market, but it won't be the quarter acre block with a 5-bedroom house on it. It'll be different sort of housing, but there is a need for that. Then there is that group of people who could fall between all of those, and a bunch of different models are going to be needed. So we need to get more stock onto the market, more appropriate housing into the market. There's no doubt that there's a supply issue there. But I also think we're going to have to start looking at different ownership models as well, and different entry point models as well. So whether they're shared equity models, whether they're common title models, where there's a bunch of different things that we need to look at so that somebody can enter the property market, have a roof over their head, build a capital base for themselves, and maybe use that to move into the house of their dreams. But there's going to be a bunch of different pathways. And if we try and design solutions which push everyone through the one ideal model about what home buyers are like, we'll get it wrong. So that's a very long answer, but I think it's the right answer. What we know is just chucking grants out to people, it's just going to inflate the prices of things. So we've got to be much more focused on the way we intervene in these areas.
And any sort of tax changes that Labor will be looking at?
Not touching negative gearing, not touching any of those things. We've been quite clear on that stuff. We will be looking at other sorts of solutions. So Jason Clare, my good colleague, has already made some announcements, and there'll be more things to come in the housing space. So I won't steal his thunder. Stay tuned to what Jason and Anthony Albanese have got to say over the coming months.
So in closing, Stephen Jones, what would a Labour government wish to offer the financial services, credit and superannuation advice sector should it win the federal election in May?
Stability and certainty is key. We have had 5 years of unprecedented regulatory change. A whole heap of that has not yet been digested by the sector, whether it's your large institutions or your small partnerships trying to run a financial advice firm or brokerage firm. We've had a tsunami of change. What the industry needs now is stability and certainty. So whether it's in superannuation, we want to ensure that 12% SGL is guaranteed and that funds are well run, well managed, delivering great outcomes to members. Stability and certainty is what is needed there. And let's just focus on the issues that need to be fixed instead of going around looking for problems that don't exist. As I've said time and again, I think the thing that we need to get right is the advice stuff, because it's broken and consumers are suffering. We need to get with the change in the payment system as well. Our regulation isn't fit for service. But for all of the other areas of the finance industry, stability and certainty and letting you digest the stuff that's already in the system and focus on what is going to be a very difficult time for consumers as interest rates are rising, cost of living pressures are getting greater. We need you guys focusing on the needs of consumers, not looking over your shoulder for the next wave of regulatory change that's going to be coming from whoever's in government.
Yeah. Thank you so much, Stephen Jones MP, member for Whitlam and the Shadow Financial Services Minister and Shadow Assistant Treasurer, for taking the time to talk to Momentum Media about what the Australian Labor Party would like to see happen should they win the federal election in May, specifically really focusing in on financial services, credit and superannuation. We really appreciate your time, Stephen, so thank you so much for spending it with us.
Great to be with you. All the best. Bye now.
So, Miranda, that was interesting to hear from Stephen Jones, obviously in opposition at the moment, but gunning for government, which obviously is getting closer and closer. So he spoke a lot about, obviously, the advice framework moving forward. What were some of the things that you took away from his discussion in the podcast today?
One of the things I thought was interesting and did sort of make sense was his comments around educations and the fact that has been perhaps mishandled in that the regimes kind of just tried to push everyone through the same one-size-fits-all approach, which was something sort of raised by the accounting bodies, and that there needs to be sort of different pathways for different kind of professionals that offer different sorts of advice.
Yes, I think that's a really good point, because quite often we see solutions trying to be put in place where you're trying to push a square peg through a round hole and it just kind of doesn't work. So it's nice to see, and I think they spoke about, the recognition of accounting skills and how that contrasts to, other parts in financial services. So, and what about the advice? I mean, we only recently had a podcast with, Bronnie Speed from Chartered Accountants and Michael Davidson and Brian Ashenden and Tracy Scotchbrook from the SMSF Association. And it was interesting to hear the Minister when we were talking about, what changes might actually come about when we look at the quality of advice review and where Labor's at the moment. So what did you take away from that discussion?
So while he did kind of raise the point that different kind of consumers are going to need different sorts of advice, and sometimes that will be more simple than a comprehensive review, he did kind of say that look at simplifying certain types of strategic advice, such as, starting a pension and super, or
making a contribution, whatever it is.
Those kind of things wasn't really something they're looking at the moment. But he did say they might be open to that as part of sort of larger structural reforms that they consult with industry on perhaps a bit further down the track.
So I think the main thing with that is, they're open to consultation. I think we have a scenario at the moment where, as an industry, there seems to be a lot of agreement on how it moves forward. So it's pleasing at least to hear that there's some level of tolerance to listening to what the industry might do. And I think, I even made the comment after the last podcast where I said, we want to be driven by, as an industry moving forward, rather than potentially coming in through regulations by regulators and those that are ultimately in Parliament of the day. So fingers crossed, we do get to a position once we get through this year, that quality of advice review, and whether we have a change of government or not, we come up with what would hopefully be far more palatable outcomes into the future.
Yeah, I think it was positive what he sort of said about sort of being open to feedback from the industry and really looking to consult. I think he made a comment about sort of having a theory, but it's not always practical in real life, and that he's open to sort of listening to industry views on that kind of thing.
Yeah, and I think he said, he's been proven wrong in the past, and he's, if he's got a view and that view has a counter argument to it, and he can see through that, he's actually prepared to listen and take that on board. So I think there's a positive in there as well. So, as is always the case, Miranda, with our SMSF Advisor Show, if you've got any suggestions around topics or speakers, what should they do?
So just get in touch at editor@smsfadvisoronline.com, and we'd love to hear from you.
Excellent. Well, thank you everyone for joining us once again on the SMSF Advisor Show. Take care, have a great day, and bye for now.